Now, I saw this article on BBC News yesterday and it really shocked me. So apparently, first-time buyers are borrowing for 31 years on average. So just 10 years ago, the average mortgage term was 28 years. Now it's up by 3 years to 31 years. Now, the average first-time buyer is also in their 30s. And if you do the math, the average first-time buyer is paying well into their 60s. And as someone who aims to retire early, the thought of retiring in my 60s has never been an attractive option. And as someone who has prioritized a stocks and shares ISA over a mortgage or anything like that, in this video I'm going to explore longer mortgages and how that can affect me as someone who has a stocks and shares portfolio. So this is my Trading 212 stocks and shares ISA portfolio. I have more than one stocks and shares ISA, but this is the one that I want to keep until I retire, and hopefully I can retire in my 40s or my early 50s. Now, recently I've been putting a lot more thought into actually buying a property. And if I actually use this stocks and shares ISA, that will allow me to reduce my mortgage term and ultimately pay a whole lot less in interest. Now, typically in the stock market, since I have started investing in 2021, I have received more than 10% every single year. So I'm looking to buy at some point. So I'm really thinking, is it worth to actually use my stocks and shares ISA, even though I vowed to myself that I'm going to be a long-term investor? Now, obviously in life, priorities change and things change, and you can't have one mentality and stick all the way through till you retire. On one hand, spending this money on property could be a good idea because once the mortgage is over, then I don't have to worry about rent and I would require a lower amount to actually retire. There's the other thing about property where if the prices increase, you can sell off your home and then you can put it into the stock market and retire. So there is that element too. However, I think that is always a risk because there is no guarantee that the value of your home is just going to go up and up. Especially 30 years in the future, you have no idea what's going to be happening to the economy. By the way, if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, all you have to do is to click the 3 horizontal line menu over here. Scroll all the way down until you see the section Use Promo Code. And in this menu, just enter my code JUBAIR and you should receive a free fractional share. Now, currently I'm 31, and if I were to get a mortgage that's 30 years, that will push me well into my 60s. I'll be around 61 or 62. Now, if I use my stocks and shares ISA right now, I can really reduce that term maybe down to 20 or 15 years even. Now, the maximum term that you can have in the UK is 40 years, which is absolutely ridiculous. Now, the reason as to why mortgage terms are increasing is because of affordability. The longer your mortgage is, the less the monthly payments. However, people don't realize that an extra 10 years, even if the monthly payments are only £200 less, because of the high interest rates, you are paying an absolute small fortune in extra payments. Now, luckily, this article actually came with a really nice calculator so we can actually visualize the difference. Now, let's say we are borrowing £165,000. Typically, lenders now will give you 4 to 5 times your annual salary. Now, because interest rates are really high right now, that is why the terms are longer. But even though the Bank of England has reduced interest rates, these very greedy mortgage brokers have not reduced their rates. So you can see if I'm borrowing £165,000 for 20 years, let's compare the difference between a 3.4% mortgage versus a 5.5%. Now you can see this increase in interest rate would mean that you are paying an extra £187 per month. So what people would do to actually reduce these payments is to increase their mortgage term. So now if I increase the mortgage term to 25 years at that higher interest rate, our monthly payments actually does go down. So when it comes to actually buying a house, let's give this actual example. So I'm personally looking at a property that is around £400,000. Let's look at this property for £340,000. Now, with a 10% deposit, that's £34,000. That is something that I do have outside of the stocks and shares ISA that I showed you. However, even then, lenders may not be happy with just a 10% deposit, and the amount that you can borrow really depends on your income. So let's say the interest rate is 4.67%, which is lower than the previous example of 5.5%. Now, with a mortgage term of 30 years, that is a monthly repayment of £1,582. Now, that doesn't seem too bad, but then again, we are paying for 30 years. Let me show you what happens when we reduce the term to 20 years. Now, as you can see, when we reduce the term by 20 years, that's 10 years less that you have to pay on your mortgage. The monthly payments go up to £1,965. Now, that is about a £300 to £400 difference between monthly payments, but you are also cutting your term down by a massive 10 years. Now, if you can find an extra £400 per month, then this mortgage sounds like a much better deal. So that brings me back to investing by having a stocks and shares ISA portfolio on the sidelines. For example, I have almost £120,000. Now, let's say my stocks and shares ISA grows by 10% a year and my mortgage is only 5% a year. It makes a whole lot more sense to still keep my stocks and shares ISA as it is growing at a higher rate. But the thing with stocks and shares is that there is no guarantee that I am going to get 10% per year every single year. So that is exactly where the dilemma is. However, I think the main thing here is that you should try your best to reduce your mortgage term, because an extra 10 years paying that interest rate, you're going to end up paying a whole lot more for this £340,000 house. So when we do the math, you can see absolutely how disgusting this is. Now, £1,582 for 30 years is £569,000. That does not even include your deposit. So for around a £300,000 loan, you are paying £569,000. Now, by reducing your term by 10 years, yes, the monthly repayments do go up. However, you will end up paying just £471,000. Essentially, you are saving £100,000 by reducing your mortgage term. Now, I really do realize that, an extra £300 or £400 per month for the average person is not something very feasible. But that is exactly why I started with my stocks and shares ISA first and really prioritized that. I have over £150,000 now invested. In 2021, instead, if I had gone down the property route, I would have had no stocks and shares ISA to fall back on. I may have locked in a smaller interest rate back then, but it would come down to renewal very soon and I would be having to pay that high interest rate now. Now, overall, it's your choice if you want to prioritize a stocks and shares ISA or a mortgage. But given how high mortgage rates are right now, I really can't blame anyone who is opting for longer terms. So make sure to check out some of my other videos and I'll see you in the next video.